The Real Investment Show.
Back to the show this morning. I'm your host, Lance Roberts. And of course, Michael Lebowitz joining us this morning as well. We're going to talk a little bit more about the Federal Reserve and kind of what's going on here. You know, one of the important aspects of monetary policy over the course of the last really decade, and this is an important point as we think about what to expect from the Federal Reserve next, right? And so we have to go back in history here a little bit just to really kind of refocus our attention on what's been happening. So during the financial crisis, obviously, a lot of things went wrong that nobody had anticipated, even though we were actually writing about the housing bubble and what the potential outcome was going to be. We were actually talking about it on the radio show back then as well, talking about subprime mortgages, talking about all these different issues. And that eventually the one thing that would derail the housing market back then, the mortgage market, everything else, would be higher rates. So when rates started rising and the Federal Reserve was hiking rates, we said, look, this is the step that begins the unwind of all this excess debt and leverage in the system. And that was when Ben Bernanke at the time was talking about, hey, subprime mortgages are contained. There's no worry here. Don't worry about it. We got it all under control. And of course, obviously, subprime mortgages weren't contained as interest rates eventually reached the level where it created a virus within a lot of these mortgage-backed securities, et cetera, and everything kind of started coming apart at the seams. So fast forward then, through the financial crisis, coming out of that in 2000, we start quantitative easing 1 in 2009, and that ran to 2010, and we got a little bit of lift out of the economy, and that was simply a function as well as yes, quantitative easing was in the system, but there's also the fact we'd just blown out the economy, and you're going to have a recovery from any really deep recession, right? Just as the recession ends, you're going to get a recovery in the system, much like we're seeing now. But the question then became sustainability. And what Ben Bernanke said in 2010, he said, we're going to do another round of QE because we understand that by lifting asset prices, it improves consumer confidence. And by improving consumer confidence, that should create more economic growth, and we should get back to an organic cycle. The problem was it never got there. Consumer confidence did return, but the devastation of finances and the beginning, and this was at the beginning of really the broadening of the wealth gap, where it was really just the top 10 to 20% of the economy that owned the majority of the stock market that benefited from higher asset prices. The bottom 80% didn't participate in that. So we never got to the point that we could actually wean off of all this monetary stimulus. And so for over a decade now, we've had to continually keep interest rates near zero. We've had to continually do QE, this kind of monetary interventions, because without it, as soon as we try to taper it, right? We tried to taper it in 2014, 2015, market crashed. We tried to do it again in 2018, market crashed. So as soon as the market crashes, well, we come back in. It's like, oh, well, we were just joking, right? Interest rates back to zero and, more monetary policy. Well, here we go. Jerome Powell on the Hill yesterday saying the mandates for measuring when we can tailor QE, right, and we can start to hike interest rates. We now have to change that benchmark so we can continue to do this, because as interest rates come up, all of a sudden 2% inflation and full employment as measured by the BLS is a benchmark we're going to get to very quickly in the current environment. So we have to change the benchmarks. And that's what we saw Jerome Powell do earlier this week. He said, yeah, we're going to change the benchmarks here to using average inflation over 3 years, and we're going to start using a different measure of unemployment, which is much higher. So this will allow us to continue to do this. He said this without saying this, but this will allow us to keep monetary policy in place. Michael Lebowitz joining us this morning to talk a little bit about this. So, Mike, what was your takeaway from Jerome Powell's speech this week?
But let me continue on what you just said. You may not even know this, Lance. M2 is a popular term for money supply. They calculate money supply different ways, M1, M0, M1, M2. It goes up the chain. M2 is one of the more popular ones. And the source is the St. Louis Federal Reserve site, which is a great source for economic data. They got anything you could ever ask for seems to be over there. M2 got discontinued yesterday. They're not reporting on M2. So they're not only are they changing the goalposts, they're hiding some of them. Right. So they're looking for justification to keep printing money. And what is really bothersome is there is no real historical evidence that what the Fed does with QE, we can talk about interest rates separately, but what they do with QE has any bearing on the economy. And in fact, I would argue it hurts the economy.
So let me ask you a question. It's an interesting point that you bring up is that, and this is not the first time the Fed discontinues reporting certain things that don't necessarily agree with them to a great degree. They used to have a labor index that they had comprised under Janet Yellen. And when it didn't work out exactly the way they thought it would, they discontinued that. They've discontinued reporting things like bank excess reserves. They've discontinued reporting now M2. Are there substitutes for these that we're supposed to be, using, or is it just simply a function that they just don't really want you to know what's going on behind the scenes?
Who knows? I mean, M1 is still there. M0 is still there.
Yeah.
But look, whether they find it useful or not, some people do, and they should publish it. Right? That's really a wonderful website with a lot of data. Yeah. And whether they agree with the data, I mean, as long as they agree that the data source is correct and the calculations are correct, they should publish it. And it makes our lives harder because they're hiding data from us. They're changing their goals. They're providing cover. That's really what they're doing. They want to keep printing money. And at this point, Lance, we know that QE and rates are actually positively correlated, right? The more QE they do, the more interest rates rise. We keep hearing from the Fed they want lower interest rates to boost the economy, yet it's now factual, right? With the fourth, fifth round, whatever we're on QE, interest rates rise during QE, and it net hurts the economy. It helps the stock market, right? I wrote that article a few weeks ago, Fed's juicing the market. It laid out 3 or 4 reasons and how the Fed pushes the stock market higher. They clearly want that wealth effect that you were talking about earlier to trickle down on the rest of us.
But see, therein lies the real problem, though. Okay, so 2 things you just said are absolutely correct. During QE phases, interest rates go up. So if I want lower interest rates, stop doing QE, right? And because again, why does that occur? Because as I'm doing QE, the stock market now knows that, well, I don't want to be in bonds. I want to be in stocks because QE lifts stock prices. So I move from a safe asset to a risk asset because of QE. And in fact, we know this because when QE has been removed or tapered, interest rates have come down. Right? In between QE1 and QE2, rates fell. In between QE2 and QE3, rates fell some. During the taper tantrum, rates fell. So we know that there's a non-correlation between QE and rates, but and as you said, there's also plenty of evidence now that generating a wealth effect in the stock market does not create better economic growth because there's no evidence of that. It just creates a bigger wealth gap.
Right, and I think there's 2 reasons for that. One, 80% of people don't own stocks. And I would actually bet that number's higher if you exclude 401ks or IRAs. I mean, yes, we all, many people have 401ks and retirement plans, but I don't have access to that money for another 15, 20 years. If my 401k doubles today, I don't go out and buy something. It's not money I think of as wealth. Right. It's not like if I just won the lottery and brought in $50,000. That's wealth that I can spend and feel comfortable spending. My 401k, I don't have that option, and I have to think about, will it be enough? And look, we're living a lot longer too. So will it be enough to provide for 30 years or 20 years or however long that lifespan is after retirement? The second one is I just wonder how much confidence anyone has in these gains. So that's great, right? If you buy a stock at 20, it goes to 40, you have to sell it, right? Until you sell it, it's a paper gain, and it's not worth anything more than the 20 you bought it for. Once you sell it, that's fine. But if everyone sells it and takes those gains don't exist.
Right.
So it's a Ponzi scheme. Ponzi scheme isn't the right word. But those gains are not real if everyone wants them. That wealth doesn't really exist.
Exactly. We saw that with GameStop, right? When everybody started to and we talked about this before, is that when somebody stands up eventually and says, I'm out, the exit to get out of the market gets very narrow very quick. And we've talked about the lack of liquidity and these type of things with the markets earlier. But the point, it's interesting when you talk about 401k plans, people assume, and I see this talked about a lot in the social media as well as in the media. Well, everybody has a 401k plan. That is absolutely not true. And going back to talking about the wealth gap between the rich and the poor, out of all the employees in the country, only 50% of them have access to a 401k plan, and only 50% of those actually contribute to one. So it's actually a very small percentage of people outside of really the top or 10, 20% of income earners and that have access to these retirement plans. And why is that? Because, well, if you're in the top 10 or 20% of income earners, you're probably a business owner. In a lot of cases, once you get over about $250,000, $300,000 a year in income, you're going to find that most of those, not all, but most of those people are business owners or very high paid, C-suite executives of major corporations, et cetera. That's what makes up the bulk of those income earners.
Right. And look, again, let me just give an extreme example. I make $50,000 a year. I'm 50 years old. I have $5 million in my 401k. I can probably retire decently, right?
Yeah.
Between the age of 50 and 65, I can't live high on the hog at all. I'm living, very minimally.
Right.
That money is serving me no purpose, even though I have a lot of wealth. It could be in a money market fund in 401k. I'm guaranteed to get $5 million when I retire.
Right.
For 15 years, it does not affect my spending at all.
Yeah, and unfortunately, the reality of those numbers is that of all the 401k plans, the average balance is about 1 year's salary at $50,000. Be right back after the break with Michael Lebowitz. Don't go away.
Baby, just how you feel. You got to roll with the punches and get to watch me. Why can't you see me standing here? I got my back against a record machine.
Listen anyplace, anytime at realinvestmentadvice.com.
In a world full of financial uncertainty, turmoil, and fear, what's the gnawing question that keeps you up at night? Richard Rosso and Danny Ratliff have the answers in our next Candid Coffee Live session, Saturday, March 6th. From markets to Social Security, 401ks to Medicare. Our next Candid Coffee is an open forum edition where you set the tone, you pick the topics, and you get straight answers. Register now at realinvestmentadvice.com for Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.